Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mark Hackett, Chief of Investment Research at Nationwide, for an update on interest rates, Fed policy, earnings, and the political environment. We have a lot to unpack here today. Welcome to Trade Talks. And let's start with the interest rate environment, as it continues to be a keen area of focus for all market participants, particularly income-seeking investors. Given elevated inflation and record issuance, what would it take to see a meaningful increase in rates?
You know, we've been surprised that we really haven't seen a crowding out in the interest rate markets from this eye-popping issuance that we've seen. Now, one of the things we've learned over the past year is you really can't be surprised by anything. But we expect over time, you're going to start seeing interest rates rise as the tapering begins. But really, the insatiable appetite of investors for yield is probably going to limit that impact. We'll probably see a little bit of upside, but not crazy upside. Now, the caveat here, obviously, is predicting interest rates is probably the least accurate thing that our industry does. We're really interested to see how investors are going to react if or even when they start to see negative returns in their fixed income space. And we've seen a 40-year tailwind where falling interest rates have given us this supplement to the income, and we've seen a price return as well. And if we start to see bonds rise, that's going to reverse. We saw a glimpse of this in the spring, perhaps, where fixed income flows started to weaken, equity flows improved. But really, as you kind of alluded to, the search for yield is really one of the most critical aspects of our business. Investors are likely going to seek alternative solutions from traditional corporates or treasuries simply because of the yield environment.
And Mark, taking this point a step further, walk us through the macroeconomic and Fed policy outlook and some of the factors that will serve as the primary determinants of how we end up in 2021.
Yeah, and fiscal and monetary policy have been a clear tailwind for markets really since the beginning of the pandemic. And we're probably approaching here a period where fiscal and monetary policy might shift to neutral or even a headwind, specifically in a year-to-year comparison. That's going to make the fundamental backdrop, most notably earnings, a much more critical factor going forward. But as for rates, we had a mini taper tantrum in March. If you remember, the 10-year spiked to about 175. We've seen since a pretty meaningful drop. Interestingly, if you look back to the taper in 2013, most of the real disruption happened during the discussion phase. But by the time the tapering actually began, rates were actually heading back down. And really throughout that entire period, equity markets were strong. So I think we're actually in a fairly strong backdrop for both bonds and stocks at this point.
Switching gears to earnings, we've seen record beats in the second quarter and positive revisions. Talk to us about the outlook for corporate earnings through the end of the year.
Yeah, second quarter results were really staggering. 90% growth from a year ago. Record levels of beats, not only for earnings, but also for sales. The themes that we saw were pretty much consistent with what we've seen over the last couple quarters, including reopening momentum on the demand side, offset somewhat by supply chain constraints and input cost pressures. But overall, a very good result. What we did see, though, was pretty muted stock price reaction to those beats. That tells us that most of these surprises were already priced into the shares. But going forward the rest of the year, we've seen positive revisions, about 25%-ish for the third quarter, about 21% growth expected for the fourth quarter. What we're really looking for, though, is what are we going to get next year? Haven't really seen those numbers rise very much. Looking for about 9% growth at this time. Really, that's going to be critical here, simply because you're trading at about 20 times next year's numbers. That leaves a little margin for error at this point.
The current political climate seems to be dominated by discussions that center on infrastructure, domestic spending, and the debt ceiling. Take us through the current and potential future state of those discussions and the consequent impact on the fundamental backdrop.
Yeah, as I mentioned a little bit before, fiscal policy has really been a critical factor in this market. We expect that that's probably going to continue to be going forward. A lot of news currently about infrastructure and also the domestic spending packages. I'm not going to predict the ultimate conclusion there, but from an investment perspective, corporate and individual taxes are probably going to rise next year. A lot of the spending from this new infrastructure and domestic spending packages, that's going to take several years. So we can actually see a headwind next year to earnings from this entire package, very different than what we've seen in the past year. Another obvious aspect of politics is it definitely influences consumers and investors' confidence. Obviously, we tend to make our investment decisions in line with our political leanings. We've seen Republicans' confidence plummet downward since the election. Democrats' confidence has surged. By definition, both of those cannot be true. We really recommend trying to avoid emotion in your trading, particularly emotion when it comes to political leanings.
And Mark, to recap and wrap up here, what are your assumptions for equity and bond market returns going forward? Among the factors discussed during today's segment, which do you feel will be most impactful to equity and bond market performance through the end of the year?
Yeah, we've really been impressed by the market's resilience. A lot of challenges being faced over the past year and even throughout this year. I think if you polled your audience at the beginning of this year, I think all of us would have taken a 19% total return for the full year. That's just what we've gotten to date, particularly given we've seen 17% last year, 31% the previous year. But really, the fundamental backdrop is going to continue to be an important part of this, particularly as fiscal and monetary stimulus starts to fade. We are seeing elevated valuations, though, so those challenges are clearly there. The path of least resistance for the market is clearly higher at this point, particularly given there's very little alternatives in the way of the bond market at this point. But I do think the easy money for the year has probably been made. Returns in both the bond market and the equity market are probably going to be challenged over the next 12 to 18 months. Think about it, a 60-40 portfolio has generated about 18% annually since the financial crisis, about 11% over the last 30 years. So investors to a certain degree are spoiled, but I think given where the valuations are on the equity and bond market, I think we need to be a little bit realistic with those returns in mind, given the headwinds that we face. So perhaps a little bit more muted bond and equity market growth over the next several years.
All right, Mark, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.